Good evening to all. On behalf of Resurgent India and on my behalf, I would like to welcome all of you in this today's webinar on a very important and relevant topic in the current scenario, the co-lending by banks and NBFCs, trends, opportunities and challenges. So this topic we have selected after discussing with all stakeholders that what need to be discussed, what to be, I think, decided, or what should be suggested in this forum, so that the co-lending, which is a very important piece between banks and NBFC, can be, I think, understood in detailed manner, and whatever the unaddressed questions are there, these can be taken up also. So I would like to welcome to all the panelists who are veteran or who are basically very experienced people from the industry. So we have very good combination of the regulator, ultimate regulator of the banking and finance industry, RBI. So Mukesh Kumar sir is there, Dr. Mukesh Kumar, GM, Reserve Bank of India. So Mukesh sir, first of all, I'd like to welcome you and thank you very much for joining with us in this today's webinar. Then we have Mahesh Goyal sir, who is the CGM of SBI. And so Mahesh sir, I think he'll join after some time. I think he told that he'll join after a little, maybe after 15-20 minutes. So welcome Mahesh sir. Then we have MS Chari sir. Chari sir is the GM NBFC Alliances and the NBFC, in the SBI, State Bank of India. So Chari sir, welcome to you and thank you very much for joining with us in this webinar. Then we have Rohanjit Singh Juneja ji, who is the Managing Director and CEO of Dhanbarsa Invest Limited. Rohanji, very thank you for joining with us and welcome to you. Then we have Mr. Nanda Kumar, who is the GM National Business Head and MSME Business Group, South Indian Bank. So Nanda Kumar sir, welcome to you and thank you very much for joining with us. We have Prakash Bhavnani ji, who is the Head Treasury and F&A. India Shelter Finance Corporation is a housing finance company. So welcome Prakash ji. Then we have Mr. Anuj Pandey, who is the Chief Risk Officer of Ubro Capital. Ubro Capital is into the MSME lending. And so we have a very eminent panel from the different background who are expert in the NBFC or banking space. But this co-lending is a new baby. So friends, I would like to just brief you that co-lending is basically kind of joint lending between banks and NBFCs. So we'll run through a small PPT, which might give you some idea that what is co-lending and how it is doing in the country. And I would like to welcome to all the participants who are here from the different background, either from banking or NBFC professionals who have joined from the different geographies also. So welcome to you all. And I will request all of you to make it more interactive. You ask whatever the questions you want to ask, whatever suggestions are there, you can write in the chat box. We'll try to cover up, and if it not be cover up, then it will be sent to all the panelists also later on for their feedback also. So friends, the co-lending, I think although the people who are in the industry, they know that what is co-lending, but for the other people, I would like to just cover up this thing that this co-lending arrangement is basically the joint lending between the two entities, banks and NBFC, to the same borrower actually. So this is often first time in the country. I think I have not seen this kind of arrangement in the other part of the world. But our speakers are, I think, well aware. They will give us the perspective of the global perspective of the co-lending also. And in this co-lending, both the entities are sharing the risk and reward in the predefined ratio. So as per the guidelines, I think minimum 80%, minimum 20% should be kept by NBFC and rest can be with the bank. So it can be more than 20% also, but it cannot be less than 20%. And the objective, the ultimate objective of the government or RBI is to basically increase the flow of the money to the priority sector. And you see that the NBFCs are the single point interface, or they are the single point contact. So they will be the front end, and the bank will supply the money to them, and they'll be the partner with that lending actually. NBFC will enter into the lending, the loan agreement with the customers on behalf of the bank also. regulatory, so there should be a bank approved policy or NBFC approved policy for co-lending. Without that, the co-lending arrangement cannot be done. And all registered NBFCs, including HFC, are eligible. So there is, I think, some discussion that the fintechs can also be covered. But as of today, typically fintech which are not having any NBFC license or HSP license, they are not covered in the co-lending arrangement as per the regulation. And the minimum 20% should be retained by the NBFC. And there is a requirement of master agreement. So both the entities should have the master agreement before start lending under this arrangement. A master agreement will be having all the related clauses that how this will be done out, the underwriting will be done, what will be the commercial arrangement between both the entities, and in case of any challenge, the partnership, how it will be resolved also. And NBFC will be a single point contact. There will be unified statement which will be issued by the NBFC. And there are two methods of co-lending, and this part is very, very important, which need to be understood that whenever their co-lending is there, so there is a direct model where both the NBFCs and banks will come together, and this money will go to the escrow account, and the borrower will get the single entry in their bank account. And the second model is there where the NBFC will onboard the borrower according to the co-lending policy tied up with the particular bank. And then they will go to the bank for the reimbursement or maybe the assignment of that portfolio, which the bank will evaluate. Bank will see that it is as per the banking norms under the co-lending policy. Then the bank can basically finance this portfolio under the co-lending model actually. So, but the only thing is that in the second model, there is no requirement of the seasoning of portfolio. Next. So if we see the comparison between the two model, the first model, in this case, the bank has to compulsorily take the share whenever the any lending is there. So this is disbursement has been decided that whether the bank will be taking the share or not actually. And we see the due diligence. So practically in case of first model, the due diligence is done by the NBFC. In the second model also, the due diligence is done by the NBFC. But when the NBFC is selling the portfolio or the doing the assignment, then the banks are doing the due diligence at their own also. Next. So these are the category of loans which are covered under the co-lending. So as I told that it's a priority sector lending covered under the co-lending. So MSME, loans to MSME, loan to housing finance, retail loan. So this is, I think, the area which need to be discussed. I think some banks or some NBFCs are in the impression that the loans which are the consumer loans can also be non-PSL loan can also be covered. I think which need to be discussed, and as per the circular, it is not defined, but I think there is a discussion, and some banks, some entities are taking this call also, but it is not clear till now. And agriculture loans and other priority sector loans. But the only thing is that which need to be understood that the revolving credit facilities, they will not be covered, or the non-fund based facilities will not be covered under that. Actually, even the export credit facilities and all will not be the part of this co-lending actually. Next. So if we see the advantage, because whenever there is any commercial arrangement, there should be win-win for both the organizations. So there are many advantages from the banking point of view. So it can get the untapped market for the bank, the digitization of the lending process. Some of the banks are not in a position to meet out the target of priority sector loans, so they can meet out these targets by way of co-lending. Lower cost of operations. So if you see that practically the cost of operations is very, very low, because all the cost is going on the head of the NBFC. Banks are just buying the portfolio, or they are just participating in that co-lending portfolio. And this area is very, very important in case of the bank is not in a position to meet out the PSL requirement. They have to park this money according to the government guidelines to the NABARD or some other scheme, where the returns are very, very low actually. So if they can come in the co-lending model, there can be the higher return on the money which is lending by the banks actually. The banks can have the cross-selling opportunity also, because NBFCs are having the single product lending only. But the banks are into savings also, banks are into the other products also, so which can help banks to multiply the revenue from the same customer. And the financial inclusion is the most important agenda of the government. So through this can also be meet out. And better utilization of surplus. I think there is a lot of liquidity the system, the banking system, which can be better utilized through the NBFC co-lending tie-up. And the cap of NBFC, so there is a cap whenever the banks are lending to NBFC directly for on-lending purpose. There is a limitation that after certain cap, the banks cannot lend further. And there is a single borrower cap also. So under this co-lending, there is no cap practically for NBFCs and banks under this co-lending arrangement. So even the NBFC can take the larger share from the banks under the co-lending arrangement. And the NBFC are known for the better collection, better reach, and better monitoring, better underwriting. So this advantage can go to the banks also. Next. Then not only banks, the NBFC are also having a lot of many advantage in terms of this co-lending tie-up. So the one major advantage that the capital is, I think, the most precious, the potent resource for any NBFC. So under this model, this capital allocation or the capital requirement will be minimal, which will help them to grow their book in a larger manner and the larger amount with the less capital. And the funding constraint will not be there, because whenever they are going for on lending tie-ups from the banks, they are not getting much of the money in the largest amount basically. But whenever the co-lending tie-ups are there, there is no limitation in terms of the amount. It depends on the bank and NBFC that what can be the maximum amount which they are looking under this model actually. And they can reach to the wider clients with the wide client profile rather basically. So suppose when we have one NBFC doing one product under co-lending, they can do maybe two more products also which are suitable between bank and NBFC. And this thing digitization, although the NBFC are doing a lot of digitization, and the low cost fund, which will help further to the borrower to get the low cost fund also. So under the co-lending model, the banks are charging certain cost, and then NBFC are charging certain cost, and blended cost is lesser than whatever is charging by the NBFC in case of direct lending to the borrower from their book. Fee income, so definitely whenever there will be the more loans and there will be no capital requirement will be less, then this fee income will add in their bottom line, which can help them for better valuation also. And onboarding of the new customer, so they can, I think, eliminate, or they can, I think, face that competition. They can be the better in a better position to face the competition, because they can offer the lower ROI to their borrowers. Next. This is the process. So where the first model, how the NBFCs and banks will come together. So the customer will be sourced by the NBFC, maybe by the digital channel or physical channel, whatever their channel they are using. Then they will do the eKYC. Then they will do the underwriting from their point of view under the co-lending policy. After that, it will go to the bank for the approval. The bank will will give the approval. Then the NBFC fund will be transferred in the escrow account. Then ENH. So this is a typical process, I think, which have 7-8 steps, which need to be followed up whenever any co-lending arrangement should be there. So escrow account is one of the important aspect in this entire thing, where in case of first model, the money should go into escrow account, and then it can be disbursed to the borrower. So there will be the escrow collection account, escrow disbursement account. So there will be different escrow account for the different activities. Next. So there is one, I think, a discussion regarding the fixed cost, fixed interest charge or the floating interest charge, and how the blended cost will be calculated. So we have just given some example. So there is the fixed rate of interest rate, because in some cases NBFC are charging fixed rate of interest to the borrower. So how the blended rate will come out, because banks are charging in most of the cases the floating rate. So there should be there will be a mix of that. The NBFC will be charging fixed rate, and bank will be charging the floating rate. Then the blended rate will come out, and if there will be any change in the rate because of the change in the MCLR or change in the rate by the NBFC, this weighted average cost will be calculated again, and this will be charged to the borrower. So this is a simple math which will help you to understand that what will be the difference in the different method of charging rate of interest. Next. So friends, as I told you that there are advantage there, and there are some advantages are there, then there are challenges are also there actually. So these are some of the challenges. This one, the common credit approval. So banks are having their own method of approvals, own method of underwriting, appraisal and all, and NBFC are having different method of underwriting. So there should be a common method for both of them. And integration of technology, which is a Herculean task actually. Most of the partners or most of the bank and NBFC partners are struggling for that, but still I think some progress is there. And the policy which are fluctuating based on the their requirement, the banks are having changes in the policies on the regular basis, and NBFC are also changing the policy. So how this can be integrated in the system, so that the impact of this changing policies should not be much on the entire process. And the alignment of the policies between the both the entities. So in case of NBFC, the borrower profile is not of the top category, top A category borrower, which will have the entire formal income tax return, profitability, and all these things, which are some of the areas which are to be taken care when the co-lending process defined between bank and NBFC. And accounting challenges, reconciliation and all, these are, I think, when the volume will increase, these things will also be taken care in a detailed manner. So this processing fee, banks are charging different processing fees. So these are commercial, I think, depend on the bank and NBFC how they are defining. And so these are the areas which need to be discussed and taken care in advance, so that there should not be any bad taste when the relationship is start, and it should not be a bottleneck for any kind of relationship actually. So bureau reporting and the hypothecation, servicing, and all these things are to be taken care. Next. These are some of the tie-ups by the different banks. We have tried on the basis of market information. We have just list down that how many tie-ups, what kind of tie-ups have been done by the banks and NBFC. So till now, I think SBI has done the largest number of tie-ups in a different category of NBFC in housing or MSME and all. And in the even MFI also, microfinance also. Then the Bank of Baroda and other banks. So, next. So there are more than 50 or 60 tie-ups are there with the banks and NBFC, and out of that maybe 30 to 40% tie-ups. I think there'll be start of the lending also, but even the almost 50% under the 50% tie-up, the lending has not started. So this is a very, I think, concern area which need to be addressed. That why the delay is there actually. Next. So friends, this is brief about the co-lending, different aspects of the co-lending. Now I would like to invite our panelists who are expert in this field, and they are very well known in the market also, and they are, I think, having experience, practical experience also. So we have Dr. Mukesh Kumarji, who is the GM, Reserve Bank of India, and he has very, very good experience on the financial inclusion side, or the priority sector lending, or MSME lending policies and the processes. So he has very good academic qualification also. So first of all, I would like to thank you to Mukesh sir for joining with us in this webinar. And RBI, because RBI is the regulator, and RBI the Brahma for this kind of policy actually, I'll say. Because you have created this co-lending model, the policy, and you told that your department has created this actually. So nobody can be better than you to discuss on this co-lending. So from the macro point of view, we would like to understand from you, sir, the co-lending model which so what the intent behind that, and how this model will help the economy and overall the priority sector lending of the banks actually. So over to you, and thank you very much, sir.
So thank you, Mr. Agrawal, for that nice introduction. You have, I think, nicely covered about the co-lending model as such. You have outlined what are the objectives behind this particular model. As you have rightly pointed out, the objective of coming behind this particular model, co-lending model, is to increase priority sector lending. So priority sector lending is one of the priority of Reserve Bank of India, Government of India, and that is why this arrangement has been thought of, wherein the surplus liquidity available with the banking sector and the reach of NBFCs, they can come together and provide lending to the priority sector. So there are different areas in priority sector. It includes agriculture, MSMEs, housing, so many other sectors are there. But one of the important sector which plays a very vital role in the growth and development of our economy, that is MSME sector. If we take the example of MSME sector's contribution to GDP is somewhere around 30%, which comes to, in absolute terms, maybe around 60 to 65 trillion, given the total size of our GDP is around 220 trillion. So in absolute number, contribution of MSME is around 60 to 65 trillion. If we talk about the lending which is happening through the banking sector to MSMEs, that is around 18 trillion. It used to be around 14-15 trillion. This year, 2021, it has reached to the level of 17.64 trillion. So if we calculate the credit to GDP, credit going to MSME sector and the contribution of MSME to GDP, it is only 25 to 27%. Whereas national level, the credit to GDP ratio is 55%. So this sector is underserved. On the other hand, this sector is a promising sector which contributes to the growth of our GDP. Its average growth rate of MSME has always been higher than the average GDP growth. So this becomes one of the priority area, and NBFCs are doing very good job as far as reaching to the NBFCs to the MSMEs is concerned. And first time borrowers are that number is quite large as far as the lending portfolio of NBFCs is concerned. So given all these factors, there was a case that this kind of model should be arrived at, so that both banks and NBFCs, they can come together and they can start providing credit to the MSME sector. Similarly, housing is another area wherein though lending is quite prominent by banks in this particular sector, but there are certain areas, there are certain segments in housing sector also where NBFCs have a reach, but banking sector generally they shy away from certain areas in the housing sector as well. So the overall objective, if we look at the areas which are excluded by banking sector, but the areas which are covered by NBFC, if these two entities, banks and NBFCs, they can come together, then the lending to those excluded segment that can be increased. So that is the overall objective behind this particular scheme, which started in 2018 and then a revised circular came in 2020. So that is what is the initial opening comments from my side, Mr. Agrawal.
Thank you, Mukesh sir. I think you have very well covered that what was the intention behind that co-lending model from the government side. One is liquidity and then increase of the priority sector lending in the system actually. So there is one question which we would like to take from you, that this are government loans specifically designed for MSME being offered in the co-lending mechanism, and what else need to be done to address challenges faced in co-lending to MSME? Actually, I discussed in my PPT also. If you can throw the light on that also, that will be great, sir.
See, as far as government loans are concerned, there are different schemes like Mudra scheme, CGTMSE scheme, under which government provides some kind of facilities to the borrowers, wherein the loan can be provided by the banking sector. So if there are some lending arrangement between banks and NBFCs for these kind of Mudra loans or other loans, MSME loans, or maybe other loans, in case of CGTMSE, there is an arrangement member lending institutions. There are some NBFCs which are part of CGTMSE member lending institution, and banks anyway, they are part of that. So if both NBFCs and banks are part of this CGTMSE member lending scheme, then they both can come together and provide credit under CGTMSE. Similarly, in case of Mudra loan also, credit guarantee fund for Mudra loan is also there, CGFMU. So if NBFCs and banks, they are both part of this arrangement, then they can provide lending under this scheme. As far as challenges part, you spoke about the challenges in MSME sector. So the challenges is known to each one of us. There are different appraisal processes which are being followed by the banking sector, and different appraisal process which is being followed by NBFC sector. So since the appraisal process is somewhat different for both these entities, that is why maybe enhancing credit in MSME and co-lending scheme as such, there are some challenges. So maybe we can discuss going forward what are the challenges, but some of the common challenges are like cash flow based lending, which is very prominent in case of NBFCs, but in case of banks, though it is taking up, but it is not that prevalent in case of banking sector. Similarly, LTV ratios, they are quite stringent in case of banks, but may not be as stringent in case of NBFCs. NBFCs, they have some discretion. In case of banks, they have stringent rules and regulations which have to be applied across the country. That is why there are some constraints from the banking side. And then there are some other aspects also. As far as speed is concerned, I think NBFCs, they can provide faster loans. That is why they are getting market, they are gaining market share. Similarly, in case of banks, the lending process is not that fast as is expected by the customers. So that is why people are going to NBFCs. But as you rightly pointed out in your opening comments in the presentation itself, that the cost of fund in case of NBFCs is very high. That is why the lending rate will also be on the higher side. But in case of banks, cost of fund is on the lower side. So that is why the lending process can also be, the lending can also be provided at the lower rate of interest.
So thank you. I think one last thing which I would like to ask from you, sir. Whenever we are interacting, because we as Resurgent India are deeply involved in the co-lending process with all the banks and NBFC, what we are seeing when we are talking about the this informal income and the borrowers are not having the proper bank statement or this income tax returns and all. Most of the banks, what we find out that they are saying that RBI will not allow us, or RBI may create some challenges for us because these are the policies. So is this right? Actually, sir, it's a big question because it's a ground reality which I'm discussing with you actually, because you are here. So this is an opportunity for me to ask from you.
Sir, these aspects are left to the discretion of banks. Among banks also, you will find there are private sector banks and foreign banks. They are able to find different innovative practices under which they can assess the credit worthiness of a borrower. But in case of public sector banks, the rules are quite stringent, and that is why the flexibility in terms of changing or bringing innovation in credit appraisal process, that is not that fast. So as far as the role of RBI is concerned, these lending decisions are left to the bank. Banks have the discretion. Bank board can decide the policies, what kind of lending practices, what kind of appraisal processes they are going to follow. GST based lending, that is being followed by NBFCs, that is also being followed by some of the banks. It all depends as to what kind of data points and what kind of database each bank or each NBFC is going to assess. Ultimately, the onus on bank to repay the depositors' money is much higher as compared to NBFCs. So that is why they are little more due diligent in terms of assessing the credit worthiness of a borrower. And that is where we need to understand their point of view also. And one more aspect which is being spoken about as I interact with public sector bankers and the NBFC players, they say the public sector banks, they hesitate in providing credit because they have accountability issues. the accountability issues, as we see, it is very well known. One of the chairmen of a large private sector bank, even post his retirement, there were some issues, there were some cases against him. So these are the accountability issues which hesitate public sector bankers in terms of taking decision. Whereas when we talk the same thing to the NBFC players or maybe private sector banks, they say that public sector banks do not lend because of accountability issues, whereas NBFCs provide lending because they have accountability of increasing the loan portfolio. So they are taking the safeguard to save their job, and that is why they are taking more and more lending. Whereas public sector banks, they have to take care of several other aspects, even long-term futures, post-retirement also.
Thank you very much, sir. Very well covered. And I think as a regulator, people are looking towards you actually, that what are your views, and which you have very, very well, I think, taken in this discussion. So thank you once again, sir. And I'll come back to you after some time. Now, friends, we have the practitioners who are from the industry. So we have Rohanjit Singh Juneja, who is the managing director and CEO of Dhanvarsa Invest Limited. The name is very, very good, Dhanvarsa. So practically it itself shows that the something we are talking about related to Dhan. So first of all, Rohanji, thank you very much for joining with us, and we welcome you. So, Rohanji, this the co-lending mechanism, basically it was, I think, designed keeping in mind that the people who are unserved and underserved should get the funding through this co-lending model. So, what do you think whether this the co-lending mechanism is achieving this goal? And the second question is, that's what step to be taken up by the banks and NBFC to resolve the differences in their underwriting process? Because you are already practicing, you have already tied up with some banks and already doing this co-lending, so you can be the better person to give us these areas, to cover up these areas. Over to you, and thank you very much.
Thank you very much, Mr. Agrawal. So the idea behind the co-lending model is a very, very unique and innovative one. So hats off to the RBI for that. And all the lenders who are tying up with NBFCs like us and many others in the co-lending model. The idea behind this model is essentially to improve reach, the quality of service to the customer, and also improve turnaround time for the customer, which is essential. So while there's been a very strong intent and attempt to substantially scale business through the co-lending model, so far we feel that we still have to reach our full potential in terms of reaching the underserved customer. The majority of the time, the reason that we are not able to scale this up, or we haven't been able to scale this up substantially as yet, is due to certain operational difficulties that happen in any relationship. But I think those operational difficulties, if they come to some form of a conclusion on them in a very, very seamless manner, it'll help to scale this up substantially, which will be a major win-win for the banks, NBFCs, and most importantly, the underserved customer. So the first part, especially from the NBFC side, is how these loans are originated, from which branches and which cities where the NBFC is present. I think that is very critical from an NBFC standpoint to decide, because do you write business just for the co-lending book? Do you write business along with other captive products that you have in a particular branch in a particular city? That's point number one. That needs to be made very clear, and that decision has to be made by the NBFC that wants to cater towards the co-lending product. Number two, it's also about making sure that your on-ground sales force and also the credit underwriting team is fully aware that a good amount of the business will be written for someone who provides the larger share of capital. Oftentimes, feet on street, especially with many of the NBFCs, they get very guarded, thinking that the majority of the capital is being provided by a bank, and therefore the book for the NBFC is not being built. So, it's hard, because oftentimes feet on street salespeople are given targets, but they are not made to realize what the importance of the target is or why they are being given the target. So they need to be brought into the ambit of what the larger objective of the organization and how to serve the customer. Number three, I think, operationally opening of escrow accounts for disbursement, for collection, for different cities in which the branches want to originate this business is a tougher task than it seems, right? It just takes a longer time frame. So I think if there's some streamlining around that process, it'll make it much easier. Number four, I think we also personally believe a dedicated retail assets team from the side of a bank would be very helpful, because you can get rid of any day-to-day operational difficulties on a real-time basis. Now, in terms of the underwriting, I think there are two challenges which, if decided at the onset, can help a lot. So one is on the process side and the other one is on the product side. If you look at both the options that are they under the co-lending circular, the first one, which is the ex ante due diligence or the joint credit underwriting model, I think that's easier said than done, because that needs to be done on a real-time basis for a loan to be dispersed to a customer. So that is point number one. Point number two, which is on the pseudo direct assignment route, I think the most important part for both the partners to decide is the product and the peculiarities of the product. Now, naturally, all banks prefer the secured product, which is either by taking Dukaan or Makaan as collateral, which is the LAP product. And the issue with the LAP product over here for many NBFCs, especially people like us who originate predominantly in the 1 to 20 lakh ticket size segment, is a lot of the borrowers do not like to give you property as collateral, or if they want to give you property as collateral, or if they agree to give you property as collateral, it has to be at a very low rate. If it's at a very low rate, the economics then don't make sense for an NBFC. So these are day-to-day practicalities that we have to live with. The other part also is, with LAP as collateral, even the borrowers know that when they go delinquent on loans, it's not the ordinary course of business for a lender to repossess on the property. And the time lag between which, in the worst case scenario, a lender can repossess on the property also is fairly long. So unfortunately, then on the income statement of the lenders, it creates a big issue, especially where provisioning is concerned. On the unsecured side, and a lot of NBFCs like to take up the unsecured business loan product, especially where MSMEs are concerned. The reason why NBFCs prefer the unsecured product is they do a thorough assessment of the cash flows that will pay the EMI for a loan. So oftentimes these are much smaller ticket lending. The cash flows are thoroughly assessed, and that's why on the P&L as well, it because of the higher yield, it makes a lot more sense for an NBFC to do that. Oftentimes banks also don't like to take anything other than declared income or banking income, whereas NBFCs can rely on assessed income to give out a loan to a borrower. So these are the issues that, if resolved between banks and NBFCs and tied up before you get into a co-lending agreement, will help significantly. So just to give you an example, many NBFCs, based on average banking balance that a customer maintains in their current account of banks, along with some kind of repayment track record, can give a pre-approved loan to a potential customer. This form of underwriting needs to be made acceptable to the banks to increase volume towards the underserved segment.
Great, I think you are very well covered. Joint due diligence is very, very important, because it should be there, but that the debt should not be affected actually, because they see the beauty of the NBFC lending, where their turnaround time is very, very fast actually. So this is one important aspect. Then the other aspect, the informal income and all. So I think you have given the good perspective. The one more thing which I would like to ask from you, the real answer, practical answer, because you are doing so how you could convince to your banker actually for co-lending, because these challenges are there, still you are doing the business actually. So if you can give the answer of this question on this forum, it would be great actually.
So, Dhanvarsha essentially is a pure play MSME lender. We focus on daily cash flow generating businesses, to small businesses like chemists, kirana stores, cloth traders, shoe retailers, hardware stores, plumbers, etc. The idea is about how you secure the loan. So you take Dukaan or Makaan as collateral. We have an unsecured loan product. On the unsecured loan product as well, oftentimes we insist on a co-applicant. The co-applicant must own a piece of property, for instance. Or then you can also secure your loan balances with gold, and then you have the unsecured product as well. So the kind of customer that we serve is the pure play Aam Aadmi, is the pure play Aam Aadmi ka business, who want lending working capital requirements of 1 to 5 lakhs, 1 to 10 lakhs. It's oftentimes to increase the size of their restaurant, for instance, the size of their business, putting up ACs in their businesses. And I think that's also what probably appeals to some of the lenders that have lent to us, and also the lenders who are doing a co-lending agreement with us, because reaching this last mile customer and also sourcing and servicing and collecting from them is not it requires a different skill set altogether. We are also present in some of the interior geographies in the upcountry markets of Madhya Pradesh and Maharashtra, for example. We're also trying to make good inroads in the Delhi NCR region, especially in the interior part. So those are not places that everyone is in, or even if everyone is in, we kind of focus on the essential goods sector, again, daily cash flow generating businesses, and hopefully that is what appeals to our lenders.
Okay, great. So you have some kind of model which is attracting to the banks actually. Okay. Great, sir. Thank you very much. So, friends, we have Mahesh Goyal, sir, who is the CGM of State Bank of India. And Mahesh, sir, is having very vast experience on from the field side, policy side. And I think currently he's taking care of the RE department of the State Bank of India. So, first of all, Mahesh, sir, welcome to you and thank you very much for joining with us. And Mahesh, sir, because SBI is the largest bank of the country actually, and in my PPT I have shown that the maximum number of co-lending tie-ups have been done by the SBI till now actually. So I think as a big brother, you have shown that I think speed or the interest that you will always be the leader in the market actually. The other will follow. So, Mahesh, sir, I think although the questions which we have, I think sent to you, these were related to MSME, but I would like to try focus on the RE side actually. This because housing finance companies are also looking for co-lending and you have tied up. So, from the your experience on the co-lending in the housing finance sector, if you can highlight that because you are already tied up with 4 or 5 housing finance companies, so what are the practical challenges are coming in the system? And I think somebody was talking about the long term, because housing finance is the long term funding for 25 or 20 years. So how you are seeing that 20 years journey will be with the banking and the co-lending partner, NBFC partner, how you are ensuring that both the partners should remain in the system and they should follow the whatever the requirements are there. So over to you and thank you very much, sir.
Thank you very much, Mr. Agrawal. In fact, I would say co-lending is a very good product, especially for unserved and underserved areas. In fact, banking was having reach to a limited extent, though we have RUSU branches, but our approach for lending is not there for all the customers because we have certain procedural guidelines. Like in case of home loan, if we take, we need income tax return for assessing the income or repayment capacity of the borrower. But whereas the new finance companies, HFCs are coming up, where they are assessing the daily income of the customer. They have got their own system of assessing the customer's requirement, customer's income, and they assess that loan. So it's going to be a win-win situation for the customer, for the housing finance companies, and also for the bankers. As co-lender, as the banks are having excess liquidity and the cost of fund for the banks, it is cheaper as compared to the NBFCs. They can provided the underwriting of NBFCs is strong enough to take care of the delinquencies. As far as the NBFCs are concerned, their cost of fund is a little higher. If they have the tie-up with the banks, then their cost of fund goes down and they can get up to 80% from the banks. As far as the borrower is concerned, as the rate of interest will be blended, or the rate of interest for the banks, it's lower, rate of interest for the NBFC it's higher. So it's a win-win situation for the borrower also. As far as the long-term relationship is concerned, we would like to have long-term relationship with the customers. In fact, if you see, State Bank of India has got 46 crores customers, one of the largest customer base. But not all are having lendable relationship where we can lend to the customers. Most of the customers could be most of the borrowers could be our customers, but for some reasons we are not in a position to finance them. But if it is there tied up from the NBFCs and then we go for financing, I think there cannot be anything like that. So we have tied up for NBFC. The biggest challenge as far as co-lending is concerned, as already discussed by the manager of RBI, is the platform. Their platform of lending is different and our platform lending is different. So how to coordinate and how to make it compatible. That is a major challenge. And system of financing also, like cash flow based financing as far as NBFCs are concerned, and that compromise in LTV ratio, EMI, NMI ratio by the NBFCs depending on the customer to customer as assessed by the NBFCs. In fact, from our team, from SBI, Mr. Charayalu has joined. He is heading the NBFC Alliance department of our bank, and he can throw more lights how we are going ahead. So from my side, I can say that as far as home loan tie-up is concerned, in future it's going to grow very good. Like before this co-lending, there was co-origination. Co-origination could not work that much as NBFCs. So for that reason, co-lending has come. In case of co-origination, the 100% finance was being done by the bank, and there was no stake of NBFCs or HFCs. But here in case of co-lending, there is a stake of NBFC or HFC minimum 20%. So the ownership on the part of the NBFC is much more as compared to the co-origination. So going forward, the unserved and underserved areas going to grow. The borrowers of that particular area can get better finance from the NBFCs. And from bank's point of view, also the number one, the priority sector lending will be covered. Most of the loans are under the priority sector, and we will be able to deploy a good amount of loan in all these through these NBFCs through this co-lending.
Right, sir. So I think you have very well covered this long term. I think because this is a discussion in the industry itself, that this long term funding in the case of housing finance, how this will be taken up by the banks, because NBFCs are not having this much of the, I'll say, the experience in terms of their journey, because banks are more than 50 years old and all basically, but some of the NBFCs which might get the tie-up or co-lending with the banks, maybe 10 years of journey or maybe 7-8 years of journey they will have, or maybe max 15 years of journey in that their entire period. So this aspect we need to taken care very well, that how this partnership will go long and what is the sustainability of that particular HFC or NBFC. So one practical question, sir, from the HFC point of view, because we are talking to many HFCs in the country, almost 90-95 HFCs are there. Out of that, I'll say 60-65 are very active, and some are large, some are mid, and some are small. The one thing is coming in the affordable kind of HFCs, where they are charging a little bit higher rate of interest in comparison to banks, or even in comparison to the larger HFCs. When we are talking for co-lending, they are saying they don't want to reduce the ultimate cost to the borrower. Actually, that's a practical thing. Reason being, there is a justification for that. They are not asking blindly. Actually, they are saying that in case of affordable housing, the borrower, the small towns and the underwriting cost is very high for that borrower, and the operation cost is very high. So if they will reduce it to in the case of the blending of the cost, ultimately they will in the loss actually. This will not be the suitable business for them actually. So from banking point of view, what do you think? Because whatever they are charging, they are saying, suppose just for example, they are lending at 14% to the borrower and they are taking money at 9% from the bank as your own lending. And in the co-lending, suppose you are charging 8%, no, not 9%, 8%, NBFC charging 14%. The blended rates will come something around 11.5 or 11%. Their operating cost itself is 3.5% actually. So this is, I think, keeping them away from the co-lending model. They want to come, but they are not coming forward actually. So what is your take from SBI point of view or from the banking point of view on that question, sir?
Ultimate intention of RBI for introduction of co-lending is reduction of rate of interest or the cost of fund for the borrower. Suppose the NBFC as on date is charging say 18%.
Yeah.
And 80% of the loan is co-lended by a banker at say 9%. And again, the NBFC continues to charge at 18%, then there is no benefit to the borrower. And that is not the intention. So from banker side also, we would like to see that the rate of interest concession is passed on to the customers. I know the cost of collection and the cost of operation for the NBFC could be high and from bank's point of view, it's a win-win situation that right from sourcing to the collection, it's being done by the NBFC. But if there is no benefit passed on to the customer, then the purpose of NBFC, this co-lending is defeated. So there has to be, it has to be a win-win situation for customers, for NBFCs and for the banks. As you said that, as I said that, suppose pre-co-lending and post-co-lending, the NBFCs continue to charge the same rate of interest. How it can be justified?
So again, sir, I am coming on that, which ultimately when they are taking money from banks, they are taking money at certain rate. In co-lending, there is not a much difference in the rate actually. They were charging 14% on the borrower when they are taking money at the 9%. In the co-lending, you are charging 8%. The NBFC cost is same because they are not passing any cost to the bank actually, because operation cost, collection cost, monitoring cost, everything they are charging, that's the same. And their ROA is something around 2%, 2.5%. It's still charging 14%. So banks, so this is a difference actually. Banks are asking that we are charging 8%, you charge 11%. But practically this will not be a marriage actually, because marriage should always be on the certain ground actually. So from that point of view, I think the NBFC and banks should come together and discuss that what is the best way of it actually. If we will keep in mind the RBI perspective that the cost may be reduced. So between 8 to 9%, suppose you are charging 8% co-lending, 9% in other this thing, then they can reduce it maybe 0.5%, but it cannot be 2% reduction actually. Over the years, because the relationship will start. जब शादी होती है तो वो एक दूसरे को जानते हैं, तो then आपस में जो है ना वो इशारों से समझ जाते हैं. So the same thing will come in this space also. Start it and then go ahead for maybe 1 or 2 years or 3 years. Then these things can be taken care. They can reduce their operating cost. Technology can come in the picture and all basically. So there is a very, very practical question, sir, which I am taking here so that everybody should get the benefit of it. But your views are also right that definitely the borrower should get some advantage. Then it's a win-win for everybody. Thank you, sir. Thank you very much for your.
Thank you very much. As you said that they are borrowing at 9%. Suppose NBFC is borrowing at 9% or 8%, and also co-lending rate is also 8%. But this is not the same. In case of borrowing, entire risk is with the NBFC. But in case of co-lending, the risk is shared.
Very good.
Suppose bank has taken 80% of the co-lending, then that much risk is shared by the bank. And that is without recourse. We are not going to ask the borrower to repay, to NBFC to repay. It's means the delinquency will be on bank only, if at all it is there. So that cannot be compared. That borrowing by the bank, borrowing by the NBFC, the rate of interest of the borrowing and the co-lending rate.
Yeah,
so I am of the strong opinion that benefit has to be passed on to the customers.
You rightly pointed out, sir. I think you hit the nail. You hit the nail actually from the banker's point of view, because the risk is in case of on-lending, the risk is on the part of the NBFC or HFC. In case of co-lending, the risk is divided actually. So at least this benefit should be passed on to the borrower actually. That's a good point, I think. There. Thank you very much, sir. I think you're very well covered, sir. Thank you, sir. So friends, now we have MS Rama Charyalu ji, who is the GM NBFC Alliances. And he's the person, I think, who is working in this department day in, day out, actually. And he has the complete knowledge of the co-lending market. And I think he's the gateway of the co-lending in State Bank of India, actually. So first of all, Charyalu sir, thank you very much for joining with us. Sir, you are deeply involved in this co-lending entire process, and the Alliance Side Department, NBFC Alliance Side Department is created only for this purpose actually. So we would like to understand what is the objective of this NBFC Alliance Side Department, and how you are basically helping the NBFC or become the conduit between bank and NBFC for this co-lending, and your experience over the maybe 1.5 years in the co-lending space. If you can share this, that will be great, sir. Over to you, sir.
Thank you very much, essentially. So I think there is a different tack altogether. The regulatory side or business side has been covered. So as you rightly said, the department's intention is to work as a single point contact for NBFC alliances, whether it is for co-lending or even for securitization, that is pool purchases also. And at some point of time in future, we may be handling all the on-lending aspects also. So my department is actually the first line of contact or canvassing for relationships with NBFC alliances. We reach out to NBFCs from our side, and also we receive inquiries from NBFCs. We do the preliminary engagement with the NBFCs to see that the wavelength matches with that of bank, and then there are bankable products with in the NBFC suite. And once we have a common ground, and then we have some commonality approach on how to share the interest or how to share the risk, then the respective product departments like our REH or real estate home loans or our SME loans or our agricultural loans, those product teams step in to discuss the product related specific issues or specific features of the products, so that the common loan policy can be designed for each product with NBFC. So this is how the entire journey happens. And then the second important thing what we are right now engaged in is that the sourcing of the platform. This activity is in process right now. We expect it to be ready shortly. So this is one other important thing which we are doing right now from NBFC alliances. So a primary objective is that, as you rightly said, RBI and Government of India are also quite keen on NBFC alliances, and we are also quite keen on NBFC alliances, and we want to see that this co-lending and other actionables through NBFCs become a significant source of loan business for asset business for the bank. This is one of the objectives.
Great. So, sir, I think one aspect which is very important is technology. So, as we have seen, the SBI did have done more than 10 co-lending partnerships with the different NBFC, HFCs, and MFIs. And whenever we are talking with the SBI or whenever we're talking with the NBFCs also, they are saying that because of technology, this is not taking headway, much of the headway basically. So what is basically limiting to the bank from the technology point of view to go further and to the lending under this co-lending model actually? And what do you think when it will be ready? We will be ready for that highway?
Yeah, actually what is happening right now is that this NBFC co-lending itself is a young product. It's very young. And so there are very few players in the market who are able to give us some kind of ready-to-use software. There are very few people who can do that. And even those software also, it's a kind of bare bones kind of thing which needs to be fleshed out significantly, both on the NBFC side and on the bank side. If you look at that kind of platform, essentially it needs to do three things. One thing is that on one hand, the platform should be able to onboard and speak to NBFCs, that is different NBFCs, different loan underwriting or originating systems, which are diverse themselves. It should be able to talk to them, onboard them. And on the other hand, it should be able to talk to my bank's core banking system or loan management system. And it should also be able to do underwriting and the escrow management, demand generation, MIS, all these things it should be able to do. It's quite a complex thing. So if you look at that, NAC is to be maintained, escrow is to be maintained, and underwriting also is there. So it's quite complicated in itself. And once again, this platform also needs to have sufficient integrations in place with different fintech players, primarily right from PAN validation or account aggregators, say like a statement of account pulling or any other GST analysis or statement analysis or fraud analysis. So this is quite sophisticated and also quite the demand is quite high. So it requires some time for people to understand. Even after we procure the platform, there will be requirement to fine tune it and implement it, do development on both sides. And I think one challenge we will see is that if you see right now from the table you have already shown, we can see that one NBFC is partnered with multiple banks. And similarly, one bank is partnered with multiple NBFCs. And there will be different platforms. So there will be some hiccups here that if one NBFC is partnering with different banks and those different banks are engaging with different platforms, they will be required to onboard to different platforms. These issues will be there, which we have to sort as we travel. It is not like, buying Microsoft. Sorry for this analogy. It's a poor analogy, but then installing it directly. No. So it will take some time.
So you are saying that technology might be a challenge as of today, but I think over the time this will go up and the speed will be fast. Okay.
Yeah, I'm a strong proponent of the principle that everything is possible. Everything is possible. Only thing is that we need to take at least some time to do it right in the first instance, because this is a very, very important point here. This is a beautiful initiative, but we need to do it right in the first instance so that banks do not get scared if something goes wrong.
Great, sir. Great. Thank you very much, sir. Thank you for your deliberation and lot of insights you have given from the NBFC Alliance point of view. Thank you. Yeah, please.
One more thing, just wanted to say to what Mr. Goyal has stated about the income sharing, which you are saying NBFCs are reluctant at interest rate.
Yes, sir.
So I just want to supplement what is stated. See, the point is that in the revised instruction, the term used is all-inclusive interest rate. It is no longer the blended interest rate. So it may not be exactly the proportional calculation between bank state and NBFC state. It's an all-inclusive interest rate to be given to the ultimate customer, which should be lower than the usual interest rate charged by NBFC. That is one point. Second point which needs to be seen is that we have done some calculations. So even if NBFC offers a lower rate of interest to the customer, by virtue of co-lending arrangement, their IRR is actually improving quite significantly. We have done that calculation. They will not lose out. And another last point we need to tell is that NBFC's capability to borrow funds and keep on lending is limited to their capital capability, right? But on the other hand, their capability to lend under co-lending will be much more than that. And it will be much easier than that.
Got it, sir. I think you have, from banking point of view, you have very well covered this point. Actually, IRR point, I think this is a dual mind in the mind of the NBFC, because although the capital requirement will be less, but the operating cost will be on the whole amount of the loan actually. So they are calculating from that point of view. So these two different views are there, which need to be, I think, taken care at the best, so that these hurdles can be overcome actually. So definitely you will see the interest of the bank and NBFC will see the interest of the NBFC, but there should be a midway although. So thank you, sir. Thank you once again for your deliberation. So friends, this is for audience. I think we have the very good speakers from the different background. So it will be, because we have given the time of 4 to 5, but it may be late of, there may be delay for maybe 25-30 minutes. So be with us, and we have very good speakers who are still to speak, who have to speak, still to speak. So be with us and be with us also, and you will get many things in this discussion actually. So friends, now we have Mr. Prakash Bhavnani, Mr. Nanda Kumar G, who is the GM, National Business Head, MSME Business Group, South Indian Bank. So first of all, Nanda Kumar sir, welcome to you and thank you very much. Nanda Kumar sir is heading this MSME department, to the right person. So we have, sir, we have listened RBI, we have listened SBI, the largest bank, now the South Indian Bank actually. So you are a so-called private bank, I'll say, old age private bank actually. And what we have seen, whenever I've shown that my PPT, we could not find out much of the tie-ups with the private banks actually. So if we would like to understand from you, what is the reason why the private banks are not coming forward that fast? The PSU banks are coming. That is one thing which we'd like to understand from you. And then another question: how can the lenders use capital more efficiently in the co-lending model actually? So as Charyalu sir is also given some highlight on that. And what are some other major operational problems that NBFC and banks have faced when it comes to co-lending? Whatever we have discussed, if you have something which you want to highlight, that will be great also. Over to you, sir. Thank you very much.
Thank you, Mr. Agarwal. To answer to your first question, why private banks have not been very aggressive into this, I think the circular came only in November 2020, and post we should also factor that last 1.5 years have been time of turbulence. So why this beautiful model has not scaled up has to be factored with that. So in that process, we have seen that some of the tie-ups have already been made, but at the same time, various lines have been set up, but availments are just happening in terms of disbursements, etc. But the point to be noted is that the NBFCs have access to borrowers, in various geographies, especially tier 3, tier 4 centers where banks don't have, and the banks have access to source of funds. So how to marry this was the objective, and especially when there was a liquidity crunch where the NBFCs were also finding it difficult to grow. That was the right point of time the circular got issued, but unfortunately, due to last 1.5 years, due to various reasons which all of us know, it could not scale up. But does it mean that this model is not scaling up? So I'm highly optimistic that all these banks will definitely be coming out. And as far as South Indian Bank is concerned, we are in the advanced stages. We have identified NBFCs. Discussions are going on. We have also identified platforms for carrying out the transactions, etc. So I'm very confident that maybe by next quarter we would be going live with at least 3 or 4 NBFCs. As far as the advantages on the capital side is concerned, and to begin with, on the NBFC front, as we all of us know that under the 80-20 or 70-30 model, the NBFCs need to have only capital for the portion which they lend from their side, but at the same time they can own the entire AUM in their home. So the scale up of business would be phenomenal under this model. It's just a matter of time where the banks and the NBFCs will have to sit together once they agree for the tie-up, decide on the policy, product, and the pricing. These 3 are very important things, because all banks have got their own policies approved by the board as per the RBI guidelines. Even NBFCs, most of the NBFCs are also coming forward with their policies in place. Discussions are going on, but at the same time, to finalize on the various things with respect to the product selection, whether secured versus unsecured, especially in the business segment or MSME, that is one challenge which banks are facing, wherein banks have the habit of doing more of secured lending, whereas NBFCs, we are seeing that it's more of unsecured, because they look at the cash flow rather than collateral or the financials. So these discussions for a better understanding and convergence is very much required. Similarly, on the rate of interest side, of course, the banks are always looking at rates, somewhere in the range of 9-10, wherein the NBFCs have a high rate of interest. So where we have to decide on what could be the blended rate, which is practically possible, so that the ultimate borrower also get the benefit of that. And similarly, there are on the assessment, on the collateral side, if it is a secured loan, if on the collateral side, how to do the documentation part, because without collateral, it's completely digital, as you all know. But when a collateral comes with the present structures in place, it takes more time on the documentation by the customer, etc. So these are the points which needs to be addressed. And coming to the advantage for the banks, and of course, they are getting access to a large population of customers. As we all know, though, while coming to the small ticket loans, banks are slightly conservative because of their reach, and probably their sourcing capabilities, collection capability, etc., are one of the reasons. While some of the large new generation banks have gone ahead in terms of acquiring this, but whereas most of the public sector and the old generation private sector banks have continue to have this problem, and that is where a tie-up with the NBFC is going to help the banks. And once they get into this kind of arrangement, and most of these lending happens as a term loan, and as we all know, once we have this arrangement in place, the customer also gets an opportunity to go for a working capital limit, and the banks get opportunity for strengthening the relationship by way of increasing the liability franchise, and it also adds to the PSL portfolio. So basically, all these become an advantage for the bank as far as this arrangement is concerned. But at the same time, we have few teething issues which we have to handle. I think the industry is maturing enough, and this financial year, say 22-23, we would definitely be seeing a lot of tie-ups, be happening, and it will go to greater heights. That is what I believe.
Great hope, sir. I think you are told that you are also starting, and this financial year will be the game changer for the industry. So that's a good thing. The one, because you are from the MSME side, the one thing which is coming in the picture in the ground reality, because I'm trying to bring the ground reality in front of all of you, because we have policymaker, we have the bankers, the NBFCs, all the stakeholders are there. So one, the ground reality is coming in the discussion, although you have to start this lending and the co-lending, but the NBFCs and banks which are tied up, that whenever we are talking, they are saying the RBI purpose is to serve the underserved and the unserved actually. When the NBFCs are going to the bank for co-lending, which are into unsecured lending, small ticket size in the rural areas and all, some of the banks are saying that this is not the piece of the business which we want to do actually under co-lending. We are not doing directly, we will not do the co-lending basically. So the entire purpose of the co-lending will go haywire actually, because you see the secured lending will be very limited actually. Unless until the banks will not come forward, will not align with the NBFC, the thought process, this co-lending to underserved and unserved cannot be possible actually. So if you can give some thoughts on that as independent view, not from the banking also, that will be great actually, sir.
So basically, if you look at the banks have been conventionally looking for assessment based on balance sheet, P&L, and of course, thanks to GST, after GST coming in, some of the banks have started looking at GST, and of course, collateral being one integral part, and that is where some of the NBFCs have come with a lot of technology and fintech types, wherein they have shown that there could be a cash flow based assessment which can happen to identify the borrower and assess the risk. And that is where some of the banks could not really come in. And probably that is exactly where now this particular arrangement is going to help such banks. As far as the attitude towards this arrangement when NBFCs are approaching banks are concerned, I think banks are really willing now. Only thing is that some of these operational issues which are to be addressed. And one thing which all banks should do is, according to me, is to have one team dedicated to look at the to grow this arrangement, not only on the tie-ups side, but also on the operational side and the technology side, so that this can scale up. And on the other side, we are also facing some issue, because as you all know, even though we have almost close to 10,000 NBFCs, almost 90% of the business is handled by a few, maybe 10 or 15 large NBFCs who are not willing to go for it. And on the other side, we have very small NBFCs who are also very hesitant, for the time being. Probably they are waiting for the market to evolve. And probably one more reason is that they are also sitting with surplus liquidity. They don't see it for the time being. But the point to be noted is that this takes some time, at least 6 months for identification, discussion, lending into the common lending program, etc. And finally, the technology integration and all. So currently, who are available in the market, according to me, is the NBFCs which are in between, those who have AUM of about 1,000 crore and outside the large company. So those NBFCs are very active, and banks are also. I think most of the banks have started realizing this opportunity. It's a matter of time, according to me. So a dedicated approach, focused approach would definitely yield better results. And I'm very optimistic about it.
Thank you, sir. Thank you very much, sir. Thank you. So now we have Prakash Bhavnani ji, who is the head treasury and FP&A India Shelter Finance Corporation. So India Shelter is, I think, affordable housing finance company. So Prakash ji, thank you very much for joining us in this webinar, and welcome to you. So, Prakash ji, you are into housing finance business, and you are into affordable housing. So, what kind of the experience you have till now from the co-lending point of view, and what do you think but the banks should do actually so that the co-lending in the housing finance should be in a better way. And the criteria, this thing, what are the policy parameters and all these things are there? Do you think there is any change is required as a practitioner point of view? And this, how can the co-lending be a win-win situation for the Indian credit industry in the aftermath of the coronavirus? What more could have been done by RBI for co-lending policy? So over to you, and thank you very much.
Thank you, Ashish ji. Thank you for inviting. Since we are overshooting the time, I'll be very brief in terms of our own experience. So we have been talking to banks regarding the various co-lending tie-ups. The very first thing which is non-common between a bank and NBFC is obviously the set of customers which we cater to. So from a balance sheet point of view, balance sheet underwriting point of view, to moving to a mindset of underwriting basis the assessed income, I think we have come a long way, at least because if I recall, every speaker within this forum has spoken about the cash flow based assessment, and most of these are bankers, which essentially tells that yes, the mindsets are there to initiate these things. There has a lot been done from RBI as well. I mean, if you see the journey over last 2-3 years, starting from coming up with the circular, standardizing the norms, coming up with the IREC norms, because essentially bringing, while you could have said that, okay, let's start the co-lending, but if you don't have the backend systems available, or they are not aligned, it could never have been fulfilled the way RBI was envisaging. So standardizing the IREC norm, which I think is one of the key tool which RBI has done now. I think by September every NBFC would be aligned in terms of that as well. So if you ask me, like you said that what is the future now in terms of the co-lending, or even stepping back, how good our experience has been. So we have just started. Why we are delayed is something to do more with the pandemic, the availability of capital in the market, and lot many other factors. In fact, that's what Mr. Nandakumar also referred, that we also need to take care of the last 2 years, wherein the pandemic hit us and everybody was working on their own agendas. And if you see during the same pandemic, companies, especially HFCs, were flush with a lot of capital. Lot many private equity money came into the market, and generally 2 years back, till 2 years back at least, everybody was thinking that co-lending is for those entities from an NBFC side which are not having the capital on their own, because if they have the capital on their own, they probably can grow the book organically rather than getting the support from this route. Why? I mean, we used to think that why to share our profit margin when we can actually keep the entire profit on the AUM which we generate. But over a period, we have realized that the industry is changing, the regulator is pushing. In fact, when we talk to PSU banks, everybody has pushed towards co-lending. So it may be one of the alternative to the current direct assignment or the PTC transactions which are happening in the market. Now, specifically talking about the future, I think in short term, we are also very bullish in next 1 or 2 years. Apart from the technological challenges, which eventually should settle down, I think one thing which regulators should come up with a kind of FAQ section. Similarly, they had done for PSL recently. If they come up with a FAQ section wherein they could probably answer questions like if it is applicable only on PSL or non-PSL, if interest cost to be taken on say on the IRR basis, or it's only the interest cost. If what kind of because when you get into a co-lending, you need a technological partner, so you are sharing data with the third party also. What are those outsourcing norms? What are the norms pertaining to data? I think this is something which probably if regulator brings on, we would have more clarity. If I talk about a long term, I think 4 to 5 years, then the things are entirely different, because there was a recent study from BCG which talks at length about the OCAN framework, which is being worked by India Stake. So India Stake is the same organization which brought us glory through UPI and then Aadhaar-based payment and DigiLocker, not many things. And now they are working on actually standardizing the credit protocol. If that comes in, probably we can see co-lending as the extension of this entire OCAN framework. So that's something we are looking forward. I mean, it will take at least 3 to 5 years from a long-term perspective. But if it happens, it would disrupt the entire lending industry. I mean, just for the clarity of audience, I'll give you one very simple example. For example, suppose a Zomato, which is exposed to the customer, they have the data, they can probably work as a loan service provider, and they would have at the back end, they would have a lender which would be funding them. This entire framework, which is end-to-end digital, wherein the entire underwriting can be with a proper protocol, which is common to all, which is something India Stake is working on. Now, the benefit is that if we talk about co-lending, we are just talking about the partnerships as of now. For example, SBI did 10 partnership, Bank of Baroda did 2 partnership. But imagine a place when you have the entire ecosystem, entire marketplace, when every customer has opportunity to get funding from anyone, and these front-end loan service provider, be it Zomato, Swiggy, or anyone, whoever is involved in the customer interaction, even PhonePe, they would be able to co-lend on a single platform. So similar thing is being done through ONDC in retail sector as well. I think similar thing would come here in co-lending space. But anyway, these are discussion point probably for some other, some other forum. But yeah, I mean, in short term, very bullish. 2 years down the line, we are just looking forward some more clarification from the regulator. And then in long term, we are looking the entire disruption in the lending landscape of India itself.
Great, Prakash ji. I think good food for thought, which you have given to all the speakers and the audience. I think this open architecture or this thing will be the game changer for the entire process. And one thing which you have openly told that earlier you were thinking that the entire profit should come to you and all basically, but now you are ready to share the profit also. That's really I think very positive approach where you want to serve the ultimate borrowers and we want to grow along with the co-lending model. So thank you very much for your deliberation, and I hope that you'll be partnering with the many banks for this co-lending. And now I have Anuj Pandey, who is the Chief Risk Officer of Ugro Capital. Anuj ji, first of all, thank you very much for joining with us and welcome to you. And last but not the least, basically, because everybody is waiting for listening to you actually, because Ugro has taken the lead in the co-lending space, which we have seen in the media, newspapers and all. And you have a very vast experience as a company in the co-lending space. So Anuj, we would like to learn from you, understand from you the journey of Ugro in the co-lending space, which you can cover up within 2-3 minutes. So everybody should know that how you could crack this journey, or how you could reach to that stage where you are tied up with many banks and you are already doing disbursements and all. Other than that, I think there is one discussion with the NBFC. They're saying that they have a lot of surplus money, that their gearing is low. Because when we are talking to the large NBFCs, HFCs and MFI, they have raised a lot of equity and the money they're lying in the system. So that's why they should go in the co-lending model actually. So if you can highlight this issue, that why they should, because you are also in the same area where you are in a lot of liquidity, a lot of gearing by low and all, but your company has taken the lead and you took the lead and you have reached to a stage where some portion of the lending is coming from the co-lending. So that is one question. Another is, could you tell us about the co-lending options available to small NBFCs? Because you see, if we go through the bank policy, many of the banks have put the condition that A-rated NBFCs should be eligible for the co-lending. Minimum this much of the portfolio should be there, the profitability should be there. So there are maybe 7-8 criteria are there, which are the major criteria where the most of the NBFC are not falling. Actually, somebody has told that more than 9,000, 10,000 NBFCs are there. Out of that, maybe 100 or 200 will be the larger one who can be eligible or the most eligible for the co-lending. But what the rest will, what will happen for the rest? Actually, there is any other model which can be developed for the small NBFCs for co-lending? Over to you, and thank you very much.
Thank you, Ashish ji. It's my pleasure to speak here. Panelists have covered most of the topics, but I'll share my experience. So we are about 4-year-old NBFC focused on lending to MSMEs through use of data science, statistical models, and technology. Now we have about 3,000 crores of AUM. We crossed 3,000 crores of AUM in March. And about 16% of our portfolio now is off book through co-lending and co-origination. We have been probably the first ones in 2019 who saw the potential and have been working with across all major banks and NBFCs to get this going. And last quarter, some of it we are now seeing success, and we are now very positive that going forward a large traction will happen. In fact, in our stated 5-year model, we are saying that at least 50% of our book AUM would be co-lended or co-originated or assigned. So the experience, I mean, and panelists have touched about this. This actually, it has evolved from the day we started, but this co-lending works best when it is a partnership of equals. Banks are large balance sheet providers, but they are generalists. NBFCs have that last mile expertise on credit delivery. So as long as this equation is clear and there is a mutual respect on both sides for this, till that time, in terms of practicalities, it is difficult to move forward. What we have been able to establish with some of the banks through, and we have spent a lot of time through a very rigorous portfolio analysis of ours, our demonstration of how our systems work, etc., that indeed this holds. And this is true for across all NBFCs who have certain vintage, who have developed some kind of an expertise in their chosen target segment. Now, typically, what happens is banks, by culturally, are more collateral-backed underwriting believers. And NBFCs, as many panelists have said, are cash flow-driven underwriters. Now, the merging of these two becomes very difficult. One is probability of default analysis, other is a loss given default analysis. Now, as a combination, if one is able to demonstrate that cash flow based lending, which is probability based probability of default based analysis, also holds true in certain cases, maybe better than a plain collateral backed, then this works. And this only data we can prove. I mean, one can keep, in fact, I must say, in our interactions with senior leadership across PSU banks, we find everyone to be very understanding of this. Some problem happens at the ground level when there is an implementation of this. So people who are executing this in banks, they are used to looking at cases, transactions in a certain way. That sometimes can take time. And the learning is that the standard operating processes, which is agreed, should be very, very specific and sort of idiot proof. So that everything which it can be covered in black and white, then the process becomes smoother. In fact, one of the panelists were mentioning on why the banks are more clued on the secured side of lending. In fact, we found, and one of the reasons why banks were not too keen on unsecured is because in NBFCs, we do unsecured as purely as unsecured. In PSU banks, there is some kind of a security in terms of charge on receivables. So the CGTMSE schemes for banks and NBFCs were different. NBFCs were allowed to take a CGTMSE cover for pure unsecured loans, but banks were not. So we made a representation, and now there's a third circular for unsecured lending through unsecured cases through co-lending. CGTMSE cover is now allowed. So with this, I think more and more PSU banks will also start covering it. The second, I mean, because this is this will take time to evolve. one suggestion is, and in fact, we made representation to RBI also, which got rejected, is that NBFCs, bigger NBFCs should be allowed to give some kind of FLDG credit enhancement to banks, so that they get so that there is no less starting trouble in case there is a fear that the method of underwriting will result in lot of portfolio losses. Let NBFCs give some FLDG so that this can, banks can look at the portfolio which is getting generated through co-lending and then take a call. But that has not gone through. But that was also one of the ways we could, fast track this adaptation across both the worlds. And there are minor tech logistical issues which keeps getting solved. For example, I will give you one example. As a regulation, NBFCs, about 2 months back, were not allowed to store Aadhaar cards, Aadhaar numbers. Banks are allowed. So a lot of times when an NBFC customer is going and getting onboarded in banks, the bank system only allows customers with Aadhaar number, but NBFCs can't store it. So this is kind of a regulatory wall one hits. So these kind of things we came across and we have solved for it. As Prakash was saying, technology integration would be key, and a lot of now players are coming in, fintech players who are developing this kind of an enterprise bus which can sit on top of the core banking solution of PSU banks and which is able to integrate with various NBFCs. Now that kind of solution today is visible, and some prototypes already we have seen, and we are working with people. Once that is done, then most of this clerical reconciliation job machines can take over and the process can become easier. So what I feel overall from progress perspective, there is unanimous acceptance across all the stakeholders, especially the larger banks at the senior leadership level. It is only a question of getting off the blocks. And one has to be a little persistent, one has to be a little patient, but we have started seeing some success.
Thank you, Anuji. I think you're very well covered. So one this question which I just asked from you is this related to the co-lending for the small NBFCs. So as we know that as per policy parameters, many of the NBFCs will not fall under the co-lending model or the co-lending eligibility with the banks actually. So is there any possibility where the small NBFC can tie up with the large NBFCs?
So there are 2-3 ways. One is, of course, as the risk outlook evolves. So just see the dichotomy where we are living with. So PSU large banks are actually taking exposure on the end customer, right? Through co-lending, but still they get stuck on the rating of NBFC. So one understands if this is happening in onward lending to NBFC, but in co-lending, but somehow these are the older times and it will take some time. But what can happen is, let us say an NBFC of our size or a bigger size who already has tie-ups, because we have tie-ups with smaller NBFCs and we have seen their portfolio. If we can become a conduit in between, which can and give a credit enhancement or an underwriting framework where the larger banks can get satisfied, then this is one way to reach across the smaller NBFC ecosystem, which we are trying through our platform called Grow Extreme. The second is smaller NBFCs can actually tie up with larger NBFCs. That is something also which is there where not many people have explored. We have tied up with a few large NBFCs in the option 1 of co-lending circular through co-origination, and that seems to be working well. So it is not that it is end of the road for very small NBFCs. It will take some time, but these are some of the things which are available to them. Okay, great. Thank you very much, Anuj. So I think from the small NBFC point of view, I'm coming again and again on the same point. Reason being, this is a big, I think, demand in the market actually, where
the small NBFCs are looking some kind of leeway where they can get the tie-up. So if they can be, I think from the regulator point of view, Mukesh ji is here. If this can be the regularized in terms of, or maybe regulator can take the call on that even in the co-lending model, then they think most of the NBFCs, the large NBFC can come forward and can tie up with the small NBFCs. Although the banks will not be in a position to do the tie-up. So what do you think that the regulation should also come for that, or it should be on the one-to-one basis actually? Hello, Anuji. Hello.
Yeah. So I thought you're asking Dr.
No, I was
Mukesh.
just this question is only that the one-to-one this co-lending between small and large NBFC is already happening basically. But if
Yes.
the regulation can be designed where some parameters should be there, and also it can be a level playing field for all basically.
I'm sure. Yes, and I'm completely in favor. In fact, my understanding is that this is the bank's individual policy in terms of where they can pick. I don't think regulation has anything to play there. And as banks evolve, they will be more open. But Dr. Mukesh, if you want to add something.
You have rightly said that from the regulation point of view, there are no enablers or there are no prohibitions as such, but you have given a very good idea that the large NBFCs can become a conduit in terms of providing access to the banks. If they are not having the comfort level, then they can reach to these smaller NBFCs through larger NBFCs like yours. So that's a very good idea. And as far as the common understanding goes, the NBFCs, the smaller ones, if they are operating in a small segment, in a small area, and there is a potential in that particular area, then I think banks should start looking for the potential, start looking for the avenues in that particular area. And as Mr. Pandey has rightly pointed out, as things evolve, maybe these kind of arrangements, these kind of co-lending arrangements will start happening with the smaller NBFCs also.
Great, sir. So, friends, I think this was a very, very interactive and I think good session from my point of view. I think we have tried to cover up the maximum number of, I think, ground reality questions to the regulator, to the bank, to the NBFCs. And I hope that the audience who have joined us, who joined in this session, they'll have better understanding about the co-lending, and they'll take the advantage of it. And I think most of the speakers and the dignitaries have openly discussed all the issues, and they have replied of the questions of the audience also. So on the one side, we were talking, and the other side, this online, the questions and answers were going on. So I think it was a very, very good interactive discussion in this today's webinar. And I hope there will be advantage to all the stakeholders. And I think there will be more learning also, more understanding. And I hope that this co-lending maybe in the next 3 to 5 years will be the game changer for the entire ecosystem, whether it's the ultimate borrower or the small borrower, which are underserved and unserved, or MSME, which is, I think, the demand of the market, because it's a pillar of the economy. They will also get the advantage of it. And the NBFC, which are larger and small, both will be the part of the ecosystem, and they will, I think, provide the loans to the small borrowers at the lower rate in the coming time. And the banks will be the money provider, and they will get the other advantage in terms of reaching to the ultimate customer, or the getting the better pricing of their money in terms of priority sector lending. And the NPA level may also be the lesser than whatever is today in the MSME segment or the priority sector segment of the banks. So from all point of view, it's a win-win for all, but time will tell us basically, because although time is also an essence, because earlier it was co-origination or co-lending. If the co-lending success will be there, then it will go on. Otherwise, it may be the new guidelines may come maybe after 1.5 years. Nobody knows. But thank you very much to all of you for showing interest in this webinar, and hope so that the future will be very bright from the co-lending point of view. Thank you very much. Thank you once again. And
Mr. Agrawal, just can I add just one point? There was some question in the chat box which I read that there was a question regarding whether the co-lending model that can this kind of arrangement can it be there for non-priority sector lending loans?
yes, sir.
As we understand, this circular is only for the priority sector lending, but an asset which is not falling in the category of priority sector lending, and if this kind of arrangement is to be arrived at, then this will be something like CLM2, wherein which is akin to assignment, and assignment can take place in any category of loan, and therefore if there is any such arrangement which a bank want to enter into, then they can approach RBI, and the common understanding says that if it is a kind of assignment kind of arrangement, then it can be permitted on case-to-case basis. That is what I wanted to add.
Very good, sir. I think this was a question also which was there in the mind of the audience also. So thank you very much for giving that clarification, and I hope this will also be beneficial for all the NBFCs. So thank you once again, and thank you all for joining with us and making it successful. And we look forward the next discussion on the more on the ground reality on the co-lending side. Thank you once again. Thank you everybody, sir. Thank you.
Thank you. Thank you everyone.